Good evening and welcome to our 2024 third quarter financial market update call at Great Lakes Private Wealth. This is Dan Murphy, founder, chief investment officer of Great Lakes Private Wealth. I've titled tonight's call, Why is the Market Going Up? The call tonight is being recorded and will be on our website, greatlakesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the third quarter and what we see going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we will be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for the call, the year-to-date price return of the S&P 500 through last night is up 22.1%. The Dow Jones Industrial Average is up 12.5%. The Russell 2000 Index, representing small-cap stocks, is up 10.7%. The NASDAQ Composite is up 23.7% year-to-date. International stocks, represented by the EFA Index, are up 6.9%. Gold is up 32.5%. And bonds, represented by the Bloomberg Aggregate Bond Index, total return are up 2.3%. It's been quite the year. As of last week, the S&P 500 has been up 10 of the last 11 months, 9 of the past 10 weeks, up 5 months in a row, and was up 6 weeks in a row through last week. It's been a resilient market with many doubters all along the way. As we've titled our call, Why is the Market Going Up? The most pressing question lately that we get from clients is what impact the election will have on the economy and financial markets. Since 1947, real GDP has grown on average 2.8% under Republican rule and 4% under Democratic rule. And the S&P 500 has returned 12.9% under Republicans and 9.3% annually under Democrats. It would be easy to conclude that the economy performs better under Democrats and the market performs better under Republicans, but the sample sizes are relatively small, actually. Republicans have controlled the government only 11% of the time since World War II, in the mid-1950s, early 2000s, and just before the pandemic. These were significantly different macroeconomic environments. Democrats have controlled the government 29% of the time, mostly in the post-World War II period and in the 1960s, but only in 6 years over the past 3 decades. Instead, the most common configuration of government is divided, which has produced 2.7% annualized real GDP growth since World War II and 8.3% annualized returns on the S&P 500. Ultimately, both the economy and markets tend to fare well under most government configurations, and the focus ahead of this election remains the concern on spending plans under both parties, leading to further federal deficits. The prevailing sentiment on Wall Street is that a divided government would be the preferred outcome next week to keep checks and balances in play with regards to government spending. In a year with growth, inflation, interest rates, fiscal and geopolitical uncertainty, there has been one thing to count on: the American consumer. Despite rising delinquencies and data that until recently showed a historically low saving rate, consumer spending has defied expectations of a slowdown. Prior to a recent revision, the personal savings rate averaged a record low of 3.4%, leading many to believe that spending was set to stall as consumers rebuilt their depleted savings. But after revisions, however, the average personal savings rate jumped to 5.2%. While still below the average in the past 5 years before the pandemic, this implies that consumers are in better financial shape than initially anticipated. Investors can find some peace of mind knowing that consumers look healthy. However, there are some divergences beneath the surface. Rising wealth has supported strong spending in the higher income cohorts, while lower income households remain under pressure. While the market is getting comfortable with either election result, the consumer remains resilient, and thus the market has continued to trend higher. There are many conflicting data points, but the market doesn't seem to care at this point. And now I'll pass it over to Dan to elaborate more on why, in our opinion, the market has gone up as well as our market outlook for the coming months. Dan?
Thank you, Pat. Good evening, everyone. What is the single biggest item on every person's mind? Of course, it's the US presidential election. In 7 days, hopefully, the election will be over, and one of the biggest uncertainties facing the stock market will be gone. Of course, it will only be gone for 3 years, since in another 3 years, every investor will start worrying about the next election. What a crazy environment we've created around these US presidential elections. Data from the Federal Election Commission has said this year the amount spent on the election in the United States will approach $15.9 billion. Think about that, $15.9 billion. That is an insane amount of money. Something seems amiss to me when a person who wants to run for public office must spend a minimum of $100 million to get elected. Back in 2000, the total spent for all US elections was $5 billion. So in 24 years, we've seen a threefold increase. If we contrast this to Canada, in 2021, they spent a total of $69 million. In Great Britain in 2019, they spent $80 million on their elections. Without money, no politician has a chance. One of the biggest questions we've been getting every day for the last 2 months has been, if former President Trump gets elected, what will happen to the market? Or if Vice President Harris gets elected, what will happen to the market? The other common comment we hear from clients and investors is, I really don't want to invest in the market until after the election. Well, the good news is at Great Lakes Private Wealth, we don't invest based on emotion. We invest based on the economic fundamentals of companies, along with a focus on which companies will be successful under either president or political party. As Pat said, in the third quarter, the stock market was up 5.8%. That return for the last 3 months is better than most money markets are earning for the last 12 months. That is why you must not let the emotion of the election or which party is better or worse for the market at any given point in time rule your investment strategy. As we review the political and geopolitical backdrop, let's review what we are currently dealing with at the present time. We have a presidential election. We had former President Trump was almost assassinated once, and then another attempt was made almost a month later. The President of the United States, with just 4 months to go, gets out of the election, and his vice president is now running for the job of president. Then we have the war between Israel and the Palestinians, and now we have Iran may get involved. And of course, we can't forget we have the war between Russia and Ukraine still raging on. If someone told you at the beginning of this year, all of these things would be happening and the stock market as measured by the S&P 500 would be up 22% year to date, any sane person would say, you've got to be crazy to think that's even possible. But that's exactly where we're at this moment in time. That is why I've titled tonight's call, Why is the Market Going Up? I hope by the end of this call, you'll have a better understanding of why the market's been going up for most of this year, even in the face of all this current political and geopolitical backdrop. If you've been a client of Great Lakes Private Wealth and listened to these calls over the years, you have a good idea of what drives the direction of the stock market. The key drivers are interest rates, corporate earnings, inflation and its future outlook, and finally, investor sentiment, or as I like to say it, the fear or greed that investors are feeling at any moment in time. Tonight, as always, we'll review these key elements to help explain why the market's going up. As Pat pointed out, the third quarter was another very good quarter for our clients. The S&P 500 was up 5.8% in the third quarter. We have followed our discipline and we've been able to give our clients a very good return while at the same time reducing our risk. This is always every money manager's goal, to get a good return while at the same time reduce as much risk as you possibly can. When you're investing in the stock market, you can never reduce all the risk. It's just not possible. But if you can reduce it 20 to 30%, that's substantial. Before I get into discussing interest rates, inflation sentiment, I want to share some of the key election facts with you. Since Election Day 2020, the Dow Jones Industrial Average is up 54.2%. That's an annualized return of 11.5%. And that compares to 10.7% return during President Trump's election of 2016 to 2020. Historically, under Democratic presidents, the return for the market's been 7.2% annually versus 6.6% annually for Republican presidents. So this is another reason why no one should be panicking. Both parties' returns are pretty close to each other. Here's another very fun fact that most investors would never guess the answer to. What is the best sector to invest in? What was the best sector to invest in during Joe Biden's presidency? Most people would guess technology. And yes, that's been a very good sector, up 112% over the last 4 years. But the best sector during President Biden's presidency has been energy, up 259% over the last 4 years. This data is provided by Bespoke Investment Group. I think this really highlights a very important point. Clearly, President Biden campaigned on scaling back fossil fuels and galvanizing renewables. And once in the office, he passed the largest fiscal commitment to climate of $369 billion through the Inflation Reduction Act. On the other hand, President Trump campaigned to support the traditional energy industry during his presidency. Yet sector performance was the opposite of what you would expect. Under President Trump, the S&P Energy Index was down 40%, while the Clean Energy Index was up 275%. Under President Biden, the Energy Index more than doubled, while the Clean Energy Index under President Biden was down 50%. Ultimately, macro forces drove markets. Varying supply, demand, and interest rate environments drove performance more than any policies or intentions by the White House. So let's look at the key reasons why the market's doing so well this year, even in the face of all this political and geopolitical risks that exist in the market. The first thing we must look at is the level of interest rates. In February of 2022, the federal funds rate was 0%. For the next 2 years, the Federal Reserve raised interest rates over and over until they got to 5.25%. Now, if rates are this high, why is the market going up? The reason the market started to go up was the anticipation of the fact that the Federal Reserve was done raising rates to combat rising inflation. And as inflation slowed and started to come down, this would allow the Federal Reserve to start lowering interest rates. As I mentioned on my call in July, I felt the Federal Reserve would lower rates at their September meeting. That's exactly what they did. In fact, they lowered rates by 0.5%. They typically do 0.25% at a time, but they felt confident enough that inflation had cooled, and they were concerned as well that the economy was slowing a little more than anticipated. This concern caused them to lower rates by 0.5%. This was the first cut since 2019. This is a very big positive for the economy and for corporate balance sheets that use debt to grow their businesses. We've had one interest rate cut so far, but the market believes that the cut in rates in September will be the first of many. The Federal Reserve meets again November 6th and 7th, and then again December 17th and 18th. Most prognosticators and economists believe the Fed will lower rates by another 0.25% at both of these meetings. The current rate on federal funds is 4.75% to 5%. So if the Federal Reserve lowers rates by a quarter at each of the next two meetings, that would give us a federal funds rate of 4.25% to 4.5%. Let's look at mortgage rates. If you know anyone who's looking to buy a house in the last 30 days, a very interesting and perplexing phenomenon has happened with mortgage rates since the Federal Reserve lowered rates in September by 0.5%. The 10-year Treasury rate has gone from 3.7 to 4.23. The 30-year mortgage rates have gone from 6.09 on the day they lowered rates to 6.54 as of yesterday. The bottom line here, the actual market rates have gone up by 0.5% since the Federal Reserve lowered rates. Why in the world is this happening? The first reason is the markets are concerned that both of the presidential candidates running for office may increase the federal deficit by a large amount. That means the national debt will increase and the amount of interest owed on this debt will balloon even further. So I believe that that's one of the reasons rates have gone up since September. The Treasury Department just released its expected borrowings for the fourth quarter of this year and the first quarter of 2025. They plan to issue $546 billion in new debt in the fourth quarter alone, and they plan on borrowing $823 billion of new debt in the first quarter of 2025. The second reason rates have gone up, many investors are not convinced inflation is dead. We've had some very big wage increases recently, and those could lead to higher inflation. Now, the current annual inflation rate is 2.4%, back to levels last seen in February of 2021. But what's interesting is prices are still 21% more expensive since the pandemic-induced recession that began in February of 2020, with only about 6% of the 400 items that the Bureau of Labor Statistics tracks are cheaper today. So out of 400 items, only 24 items are cheaper today than they were back in 2020. If inflation starts to go up again, this will cause the Federal Reserve to raise interest rates again. That, I feel, would lead to a very large sell-off in the stock market. The last reason for rates rising in the near term is the economy is not slowing as much as the Federal Reserve would like. In fact, many believe the economy is starting to strengthen again. In 2021 and 2022, the economy got hot and inflation took off. The market does not want to see inflation get going again. In short, we have some mixed indicators saying the economy is slowing and some that say it's accelerating. Currently, we just don't have clear-cut data. Now, that's another segue to talk a little bit more about inflation. Back in 2022, the Federal Reserve stated that until inflation was below 2.5%, its goal, and unemployment was above 4%, that they would be restrictive monetary mode. That was done to get inflation under control. They hoped raising interest rates would cool down the economy and slow down inflation at the same time. Remember, on these calls, I've said the Federal Reserve's mandate is full employment and inflation below 2.5%. Well, we finally have many signs that inflation is slowing. Last month, the CPI Consumer Inflation Report showed inflation was up by just 2.2%. And for the last 12 months, the rate is 2.4%. The PCE index, the Personal Consumption Expenditure Index, which is one of the Federal Reserve's favorite through August, was up 2.2% on an annual basis. So these indicators are all going in the right direction as it relates to inflation. Now let's look at a cost of living chart. one of the most important things affected by the CPI is the annual increase in Social Security payments. In 2022, the COLA or cost of living adjustment was 5.9%. In 2023, the COLA was 8.7%. In 2024, the adjustment was 3.2%. And next year, the COLA adjustment will be 2.5%. So you can see inflation is clearly coming down according to US government data. Let me highlight a couple of items that are surprisingly falling in price. And you can see from the chart that oil is down 16% over the last 12 months. Now, that is a real surprise. With everything that's going on in the Middle East, you would never expect oil prices to be going down. The main reason for this is because the US has become energy independent. Natural gas is down over 31% over the last 12 months. And lithium, which is used in electric vehicle batteries, is down over 56% over the last 12 months. Now, not everything is coming up rosy when it comes to inflation. If you drink coffee in the morning or you like candy bars like I do, we have inflation. Coffee's up 31% year to date and 55% over the last 12 months. Cocoa's up 61% year to date and 78% over the last 12 months. Well, the last thing that I want to talk about is gold. It may surprise many that gold's up 32% year to date, and it's up 36% over the last 12 months. We've taken advantage of this by having stock exposure to mining companies or exchange traded funds. Inflation is falling and appears under control, though, at the present time. Now, one of the interesting things we looked at is a report recently from Ned Davis Research, which looked at the 5-year average of inflation and found that whenever the CPI is trending 0.5% below the 5-year average of inflation, the S&P 500 rises at an annualized rate of 14.65%. The good news is inflation is trending below this 5-year average, and that's a positive for common stocks. Of course, we'll watch it very positive for common stocks over the coming 12 months. Remember the analogy I used in April of 2024 quarterly call. I said the Federal Reserve needs to turn the heat down on the pressure cooker of the economy without turning the heat completely off and causing a recession at the same time. I believe they've achieved this goal. We may be on the verge of the proverbial soft landing for the economy. A soft landing is where the Federal Reserve raises interest rates to kill inflation, but does not kill the economy at the same time. And again, I think the Federal Reserve is very close to claiming victory, and this should be a very big positive for the economy and the stock market. Now, we're currently in the thick of corporate earnings being reported. So far, earnings have been very good for most companies. They've been able to have better earnings per share in the face of slight misses on revenue. And that's equal to that 75% beat is equal to the 10-year historical average. Artificial intelligence has remained a focus for many companies, and some are starting to find ways to use it to cut costs. This is starting to be reflected in corporate profits. McKinsey and Company found that 33% of businesses using generative our artificial intelligence cut costs, especially with repetitive tasks. If you've been in a McDonald's or any other fast service location, you'll see they're using more and more robots and computers and screens to take orders. Let me share a couple of examples of other AI is helping other companies. In email marketing, tools like Zeta Global, 7th Sense, and Automizzy allow businesses to improve sales through more fine-tuned personalization and timing of their email sends. AI chatbot providers Get Jenny and Live Person help businesses save money and provide 24/7 support with relatively little effort. Chatbots can answer repetitive customer questions and reduce research per inquiry, freeing up employees for more demanding tasks. And this helps the earnings of companies in the future. Now let's talk about the sentiment or fear and greed. Right now, the fear and greed index is currently at 62, which is in the greed zone, but just barely. The Ned Davis daily sentiment is just below the overbought zone. In general, we're nearly overbought on sentiment, but not exactly there just yet. Recently, there have been studies done looking at how's the market done when it's up so much through 9 months of the year. Sentiment Trader, a publication we subscribe to, did a report on October 21st looking at how the market's done when the stock market is measured by the S&P 500 has been above its 200-day moving average for 242 consecutive days. Going all the way back to 1928, whenever this occurred, 6 months later, the market is up on average 7.2%, and that occurs 85% of the time. 1 year later, the market's up on average 13.8% and is up 77% of the time. Both are pretty good numbers for the market. Now, there remains over $6 trillion in cash on the sidelines. The U.S. money market fund industry attracted $127 billion of fresh capital in the month of August alone. This is the biggest monthly haul this year, even as rate cutting expectations are growing. Seasonally, we are at the stronger part of the calendar year, with November being up 11 of the last 12 years. This is another tailwind for the market. When was the last time the S&P 500 fell more than 1% in November? Guess what? It was 2008. And since 1950, November is the best month of the year for the stock market. It's also the best month of the past decade and the best month in an election year. The median return for the S&P 500 from October 15th to December 31st in election years is 7.04% since 1928. This implies a year-end level of 6,270 on the S&P 500. Till just last week, the market had not suffered back-to-back losing days for 30 trading days. This is only the 9th time since 1928 that this has occurred. It really shows just how strong the market's been and how it's not given anyone a chance to get in if they're waiting for a big sell-off. The big sell-off has just not happened. Whenever the market has gone over 30 trading sessions without back-to-back down days, the market a year later is up on average 14.5% and is up 88% of the time 1 year later. When seasonality is positive and the momentum of the market's positive, it tells us that even though the market's gone up almost nonstop by 22% year to date, it can still go higher. One of the hardest things for investors to do is let their winners keep winning. The natural tendency is to sell your winners too quickly. When you do this, you miss out on the really big gains that can occur. What we do is follow our discipline, take the emotion out of investing. This is why we've generally been successful year after year. So now that the Federal Reserve has started to lower rates for the first time since 2019, what happens next? With inflation under control and the possibility of another 0.5 to 0.75% cut in interest rates over the next several months, the outlook is positive for stocks. They won't cut rates all at once, and I believe will lower rates at a little slower pace than normal just to make sure inflation truly has been managed. At their meeting in November, I believe they will lower by another 0.25%. And then in December, we'll wait to see the data to see if they'll lower by another 0.25%. If inflation or the economy gets much stronger from here, they'll wait to lower rates until the data says inflation and the economy has slowed enough. The most important point to focus on is we are now entering a lowering cycle for interest rates for the first time since March of 2020. Do not underestimate this positive development for common stock prices going forward. I want to review again some important facts with you as it relates to inflation and interest rates. If we look at how stocks, bonds, T-bills, and inflation have done over a long period of time, stocks still represent the best hedge against inflation over the long term. Since 1926, inflation's averaged 3%. Treasury bills have returned 3.3%, and bonds have returned 5.1%. The best performing asset class over time continues to be common stocks, with a return of 10.4% since 1926. This data is from Ibbotson and Associates. If the economy does not get overheated and inflation continues to behave itself, we could achieve the soft landing the Federal Reserve and stock investors would love to see. In a falling interest rate environment, smaller companies typically do better than larger companies because smaller companies tend to borrow money. But when rates go up, those smaller companies get hurt by the higher interest. They have to pay on money they have to borrow to keep their businesses going, which in turn makes them less profitable. Conversely, if rates go down, they will pay less on the debt. The other factor that helps smaller companies, if rates are falling, it usually leads to the economy improving over the next 6 to 12 months. So that's a bonus as well to smaller companies. There's still a lot of skepticism that smaller companies will outperform the big cap mega tech names. Once the election's over and we get to a more normalized environment, we'll see if rates fall further, making the smaller companies the more attractive place to put funds. The biggest unanswered question still remains, are we in a trend towards falling rates, or is this just a one-time drop in rates? Of course, no one knows the answer of that for sure. We'll just have to wait to see how things develop over the next couple of months. Many of these large cap names are still sitting on piles of cash, and many have no debt. This is, again, a big reason why they've done so well, because they have not been affected by higher interest rates. Many of these large companies also continue to buy back their stock. And we've even started to see some stock splits for the first time in years. As I said earlier, we are leaning our new purchases to medium to smaller names that have potential upside in their stock prices. We've had a very good year so far in 2024. I want to share a contrast of how different money managers have performed over the last 12 months. Most colleges have endowments, and an endowment is created to hold gifts of stocks and money given from alumni and other donors who support that particular institution. This money is then used to offset tuition increases, build new buildings on campus, and other worthwhile endeavors of that particular institution. This past week, Barron's reported that Princeton University's endowment, which is $34 billion in size, earned just 3.9% for the last 12 months. They could have done better investing in US government T-bills at 5% than they did. And according to Goldman Sachs Pairs Trade, the average hedge fund, which supposedly have some of the smartest investors around, believe it or not, are down year to date. I highlight this just to point out how well other investors are doing in comparison. So let me summarize what I've stated tonight. First, we have finally seen the first drop in interest rates in over 5 years. I believe we are in a falling interest rate environment. I believe the rates will fall at a much slower pace than in the past cycles due to the Federal Reserve's fear of seeing inflation take off again. I believe this will cause them to lower rates at a slower pace than normal. In my past calls, I said I don't think rates will ever go back to the lows of 2020. We are in a normal environment for interest rates now. What does that mean? It means the Federal Reserve may only lower rates to the 3.5% level rather than 0% that we saw in 2020. That puts home mortgage rates somewhere in the 5 to 5.5% range at some point in the next 12 months. Inflation has come down quite a bit, but will most likely not go below 2% anytime soon. This is because of the wage increases, and prices usually never come down in a major way unless we have a major recession. I do not see a major recession at this time, so therefore it'll be hard to see inflation go any lower than 2%. Investor sentiment is near the overbought range. A correction in the market sometime in the first or second quarter of next year will correct this condition and bring some fear back into the market. But as of right now, once the election's over, a major uncertainty will be removed, which will make most investors a little more confident to invest in the stock market. I could see a higher move in stock prices once this uncertainty is removed. Corporate earnings are very positive, and that should allow stock prices to move higher over the short term. Once we do get overbought, I'm sure we'll take some of our chips off the table and become more defensive and protective of all the profits we've achieved. When you take this backdrop of factors, lower inflation, a slowing economy, lower interest, if history is any guide, then we should be looking at small and mid-cap stocks going forward, as they represent better values than many of the mega cap names that frankly are overpriced and are overowned. As far as the election goes, no one can predict that. As far as when the war with Russia and Ukraine will end or the conflict between Israel and Hamas will end, no one can predict that either. I do believe, though, we're getting closer to the end of both of these conflicts, and if I'm right, this would be very bullish for global markets, including the US stock market. So we have to invest based on what we know and see is actually happening in the economy. We finally have this first drop in rates in over 5 years, and inflation is down and stable. The US economy is the best in the world. Take all that into account, and the outlook for stocks is positive. As we finish our second year at Great Lakes Private Wealth, it's been an amazing journey. I'm extremely proud of what we've accomplished, and I'm excited each and every day to see how we can make your money grow and help you achieve all your financial goals in the best way possible. Our team here at Great Lakes Private Wealth is here to help you every single day. I want to say thank you to my team, and I especially want to thank you, our clients, for your loyalty and kind words of appreciation. You have my unwavering promise that everyone at Great Lakes Private Wealth will do everything in our power to continue to earn your trust. As we approach Thanksgiving, we all have much to be thankful for. Thank you for listening tonight, and have a great rest of the year. I look forward to talking to you in January of 2025.
This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or the best interest of all investor types. This information should not be relied upon as research or investment advice and is strictly for illustrative, educational, or informational purposes. Opinions expressed in this presentation are subject to change without notice. There is no guarantee that any forecast made will be realized. Commodities, including precious metals, carry substantial risk and have experienced periods of extreme volatility. Investors in commodities may be affected by changes in overall market movements, commodity index volatility, changes in interest rates, or other factors affecting a particular industry or commodity. Past performance is not a guarantee of future results. Investing involves risk, including the possible loss of principal. Index performance is for illustrative purposes only and does not include dividends. Otherwise noted, indexes are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, or reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, an SEC-registered investment advisor doing business as Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor. Thank you.